Hello and welcome to Wall Street Wire News, where you get today's market in minutes. Hi, I'm Dave Okenquist. Joining me is a special contributor to Wall Street Wire News, as well as a former Wall Street bond trader, Mr. Rodney Johnson. And we are joined by Charles Sizemore, the editor of the Sizemore Income Letter. Gentlemen, thanks for joining me this week. I want to jump right into this, which was a statement from Jay Powell, who said he's not planning on raising rates until we get back to full employment, which could be a while. Rodney, I will throw this to you first. We could be seeing some rising inflation on the way, right? As Powell basically says, I'm not going to do anything about it for, at least a year or two, depending on how long it takes to get back to full employment.
Right. So the Federal Reserve doesn't control inflation, right? What they try to do is affect it after it's already moving. And so they lower bond rates, hopefully making borrowing so cheap that people will be motivated to borrow and spend like crazy. That will generate activity, more money chasing not more goods, or rather the supply of goods is not rising as fast as cash or demand. And so that creates inflation. That's the goal. It's been a goal for a really long time, by the way, and they haven't done a good job of getting this accomplished. They're going to get an assist. They're going to get a huge assist from the federal government, not only from the CARES Act of a couple of $1 trillion, the Federal Reserve printing another $3.5–4 trillion, but the federal government putting through $600 billion in December and more relief. And then, of course, this $1.9 trillion relief package that Biden has on the table right now. All of that money will go out there, and a lot of it will get spent. And then we have potentially an infrastructure bill behind it. And so I think you're going to see inflation. I don't think the Fed is going to come in and attack that as it's rising. And so what we're going to see is inflation without a counterbalance when this eventually picks up some speed, which I think is later in the year. And so, yeah, it's coming, and people need to pay attention, because at the end of the day, what it does is it steals money from savers. And people should not be confused on this fact. Federal Reserve is not going to raise overnight rates. So you're still going to earn 0.1 on your savings account, and yet you're going to see inflation at 2.5% to 3%. So you're going to lose roughly 2.5% to 3% of purchasing power every single year, just because you kept your money in the bank. It is a redistribution plan from savers to spenders. That's exactly what this is.
Charles, your thoughts?
Yeah, well, honestly, what he said, that's very much what's going on here. The Fed's made it very clear they will not be raising rates, and they're willing to let the economy, kind of quote, run hot for a while before they clamp down. As for full employment, I don't have the figures in front of me, but remember like how long it took to get to full employment after the 2008 meltdown. I want to say, when did we reach full employment? 2015, 16, thereabouts?
It's really more like 18, I believe.
Yeah,
18,
okay.
19.
Well, in that case, it took 10 years. So if the Fed is not looking to get more hawkish until we reach full employment, is it going to be 10 more years? I mean, not that, the last recession necessarily means, it's going to take exactly that long for the next one. Maybe it's less time, maybe it's more.
Yeah. And by the way, I got a quick calculation here. In order to get back to where we were by basically January of 2023, the economy would have to add 500,000 jobs per month through there, which that does not seem very likely.
No, it doesn't. And particularly if you look at some of the things that are being rammed through in Washington right now, the potential $15 minimum wage, that's not going to get you to full employment any faster. If anything, that's going to slow it down, because companies do have to look at that and say, okay, well, this job, I mean, this is not an indictment of the worker, but this job itself might be worth $10 an hour. Well, we're not going to pay 15 for that job. It's not worth it. It's a money losing proposition for us. So that's a job that's not created. So it remains to be seen whether the $15 minimum wage, makes it through the bill. But if it does, that's going to be another roadblock to reaching full employment. One of the things I would toss out is, we're talking about $1 trillion here, $1 trillion there. I mean, if after a while you get desensitized to it, but 1.9 trillion, that's about 9% of the entire U.S. economy right now. And remember, this isn't the only federal spending. This is just new federal spending on top of everything else that equals 9% of GDP. So, that's what we're dealing with right now.
Just to add on to that, the goal of spending to create inflation is that people will demand so much of X that businesses are motivated to provide more of X, or new businesses are motivated to, entrepreneurs are motivated to start new businesses in X. And so restaurants are a great example, right? The pandemic ends or eases or whatever. We have more money in our pockets because of this relief spending. And so more of us want to go out to eat, but there are fewer restaurants. At first, prices go up because restaurants can do it, but then other restaurateurs come in and open new businesses, and they have to hire people. That's great, but it doesn't address that there are many things for which there is no supply, elasticity, as it's called. And so you're not going to be buying more flour just because all of this is going on. And yet the price of flour is going up because of incredible demand from China for grains and other things. And so we're seeing inflation happen that is not going to do anything for jobs. And so it's going to be one of those sticky things of, wow, prices are going up, and yet employment isn't moving toward full employment at the speed that anybody wants. And part of that is going to be that people have been leaving the labor force over the last several months. We got the numbers last week for January, and I believe it was 500,000 people just checked out. And so what happens, of course, is as there are more jobs available, people start coming back to the labor force, which makes unemployment look worse. Things are getting better, but since more people are looking, it looks like more people are unemployed is what it is. And so I think it's a weird metric that the Fed is using to say, hey, this is going to be the focus, and we're going to let this thing over here run. It's very unfortunate, but I think that's exactly what's going to happen.
And so what are we looking at here for inflation to rise? Say we get, say Powell stands pat, doesn't raise rates, maybe just presuming the $15 minimum wage goes through. Looking at inflation here year over year is about just under 1.5%. I mean, are we talking like 3, 4, 5, 6%, or is that higher than you expect?
It's higher. If we get to 3, and I think we're going to get to, I think it's going to go to 2.5 in April and May because last year prices dropped. And so it's going to look weird for a couple of months, and then it's going to come back down in the early part of the summer. But by August, I think we're up to 2.5. And by the fall, I think we're at 3 and popping over 3 a little bit. And that should be enough to catch people's attention, because our productivity isn't going to grow to attack that. It's going to be all about money flow.
Charles, if people are a little bit concerned about this, they want to get ahead of it. What can they, what's some ideas of what they might want to do to not get hit by this inflation, savers, people like that?
Yeah, well, there's not a lot of great options. There's what I've considered decent options or good options, but not great. If you want money in the bank because you're wanting to keep cash on the sidelines in case we have a market dip, or you're just conservative and you just want to have cash, then you are going to get punished. Now you could mitigate that by buying traditional inflation hedges like gold. Now, of course, gold is not a perfect hedge. It has its own supply and demand issues. So you can buy gold and it could fall for it. It could fall on you. You could buy TIPS. You could buy Treasury inflation protected securities, which are government bonds that have an inflation adjustment to them. That's not a decent way to protect yourself, though you are at the mercy of the government's definition of inflation. So the government's definition of inflation and what you experience in the real world are not always the same thing. So that also is not a perfect hedge. But I would say, if you have cash and you're wanting to maintain the purchasing power of that cash without taking a lot of investment risk or credit risk or whatnot, something like TIPS is probably your best bet for now. It's not great, but it's probably your best bet.
Rodney?
Yeah, and to Charles's point, the government doesn't want you to have a lot of good options for safely, addressing inflation. They want you to go spend the cash. That's the whole goal, right? No, you can't protect that purchasing power. Yes, you have to go buy a thing or an experience. In the investing world, look for something that is as safe as you can that's paying a dividend. That's kind of the thing, right? Bonds aren't going to be your friend because they're going to have their core value, their actual, capital value eaten away if interest rates do rise some. And I think longer rates will pop up some. If you're looking at dividend paying stocks that have been long and boring, they're a pretty good way to do it, but you have to pick up a basket because then you have the individual stock risk. And again, it's hard. They want it to be hard because they really want you to just go buy stuff.
All right, I want to move on to
about that, by the way.
Go ahead.
Ray Dalio of Bridgewater, he's biggest hedge fund in the world, I believe, still, but he had a rough 2020, but I believe they're still the biggest by a decent margin. He's pointed out for a while that the biggest risk to his model, which his model is basically the traditional asset allocation, stocks, bonds, commodities, but he applies a little bit of leverage to it to give it some juice, right? The whole risk parity deal. Well, he knows his risk, and his risk is that, okay, well, if we're playing this game and we have a lot of bonds in the portfolio, if we do have inflation, those bonds are going to get zinged really bad. So what he has started to do, or at least what they've telegraphed, they don't exactly provide blow by blow details here, but what they've telegraphed they intend to do is replace some of their bonds with really low volatility dividend paying stocks. It's not a perfect substitute. If you look at the way stocks and bonds react to market news, dividend paying stocks are not bonds. Like, they do not react the same way, but they do provide, if you're looking, again, if you're just looking for long-term stability, that may be your best bet right now.
Excellent. Fellas, I want to shift to energy stocks. So there's a story here from CNBC as a new commodity super cycle is underway, something we actually touched on last week. There could be big gains ahead for the energy sector, according to Marko Kolanovic, JP Morgan's head of macro, quantitative, and derivative strategy. The firm said that a number of factors could drive prices higher, including retail investors' interest in the sector. Rodney, what are you seeing here in energy stocks?
I'm a big fan of it. And I'm looking at the oil sector. And so it's weird, right? The oil sector has some people on the other side of the planet that can turn a tap and make it, flow slower or faster when they want. And they've chosen slower by a couple of million barrels a day. But it's just a couple of million barrels. We have to remember that we use about 96, 97 million barrels of oil a day. And so OPEC and then the group that is led by the Russians altogether called OPEC Plus have chosen to put in place oil quotas on all the producers to make prices go higher, which has worked. But you have a lot of people in the Western world who are saying, look, I'm looking down the road at this and I'm choosing to move toward renewable energy sources, carbonless energy sources proactively, because we don't want the PR hit. We don't want everybody hating on us. It's all this other stuff.
Yeah.
That's going to make a difference because OPEC Plus can't make up for that. And this is becoming a very difficult point in the energy world because Shell just announced this week that they peaked in their oil production in 2019. And so Shell Oil projects that they will produce less forever. And so they're not investing capital on new recovery and exploration. And that's the thing. You can identify an oil field, on land, underwater, wherever you want. Okay, there's 1 billion barrels of oil there is what we estimate. But if you're not drilling the holes and putting in the infrastructure to get that stuff out, it doesn't mean anything. Mm-hmm. And so the large Western energy companies are choosing to put much less capital toward this growth in production. And so over the next 3 years, you're going to see their production fall off. And as that does, you're going to see a restriction in supply. And while we may see electric cars kind of being the thing here in the United States and across Europe and even some in China, you still have 1.4 billion Indians that want to drive something. You got a lot of people in the developed world that want to drive stuff, and fossil fuel is the thing. And Americans have 280 million cars. We are not replacing those with electric cars next year, 2 years from now, or even 10 years from now. And so oil is going to be around a long time. As we see supply shrink, I think we are certainly in this kind of growth market for energy.
Charles?
I would spin it a little bit differently. Think about tobacco stocks over the last, call it 40 years. Tobacco has not been a growing industry. It has been a shrinking industry. Every year, there are fewer smokers smoking fewer cigarettes. Yet that has not stopped tobacco stocks from actually performing pretty well. Why? Because they do not invest a nickel in capital. Well, that's an exaggeration. They don't invest much in capital expenditures because they know it's a shrinking industry. Instead, they also invest nothing in marketing. So instead, they just squeeze every penny they can out of, just through cost reductions, through lack of marketing, lack of capital investment. They're able to actually generate decent returns, and they reward their investors with dividend hikes and share repurchases. I think energy could be kind of the new big tobacco. and kind of for similar reasons for that matter. Tobacco is a taboo investment. Nobody wants to be a merchant of death. Well, this is an exaggeration, of course, but a lot of people do view the energy sector as a merchant of death for global warming or whatnot. So if you take the contrarian view that, okay, I mean, shrinking companies can actually be a good investment if bought at reasonable prices, and if they reward their shareholders with, if these companies are smart enough to know they're shrinking and react accordingly, they can still be good investments.
Well, and to Charles's point, this goes back to what we talked about a minute ago with finding a place to protect your capital from inflation. In my head, I was thinking tobacco stocks because, like you said, they put nothing toward marketing. That's for two reasons. One, they're not allowed to market in most instances. That's why you don't see tobacco advertisements, because there's so many things they can't do anymore. But two, who wants to advertise, right? It's not like there's a bunch of new people coming into the tobacco market that you have to fend off so that you can, hold your market share. And so I think Western energy companies are looking at the same thing. How many new oil companies are going to pop up over the next 10 years in the West? It doesn't make sense. And so to that end, if you're buying a company that's already, maybe not hated, but thought of poorly, and yet they're throwing off a bunch of true cash.
No, Rodney, I would say hated, honestly. I mean, look at the way Wall Street analysts even talk about the energy companies, and the way pension funds and endowments talk about energy companies. They talk about them as if they're a pariah investment. I mean, I would say it is a fair statement and not hyperbole to say they are hated right now.
Well, and to that point, I don't think they're hated the way that tobacco companies are hated, but hated is a great term for it. If they're already hated, then you've taken out a lot of the risk of ownership of that stock, because a big risk on Wall Street is investor psychology. And so if that psychology is already quite low, then you know what? You get to kick that one to the curb, and now it's just the fundamental business and cash flow.
Yeah, but to Charles's point, if you're destroying the planet per se, that is probably worse than selling a cancer-causing product. So I can see where that anger is. And this is why if you ever do see an energy commercial, there aren't as many of them, but it very much emphasizes unity around the world. Green
and
energy.
green.
It has nothing to do with, pumping out barrels of oil.
There's always trees and birds chirping and all sorts of stuff that
what are you guys really doing? You're not planting trees.
But birds distinctly not covered in oil, just happy birds.
Good stuff. I want to shift. I think it could be a good debate here on this topic. Uber, a story here from Wall Street Wire News. Uber's big miss doesn't mean a thing about its huge long-term potential. As we note here, the lockdowns basically killed Uber's rideshare business as no one was going anywhere. I think Uber itself shut down. Now things seem to be open as well as normal. Now I can hail an Uber fairly easily. I just wear my mask. But beyond that, beyond ride sharing, was Uber's $2.65 billion acquisition of rival Postmates for food delivery. And Charles, I know you'll like this one, $1.1 billion acquisition for alcohol delivery service Drizzly. So these are two big things here. And really, I think it speaks to the way we change how we live as the pandemic has accelerated a lot of that, getting things delivered to us at our homes. I mean, I see we have an army of Uber drivers delivering a whole bunch of different products to people. So you don't have to leave your home. Some people might not like that idea, but it's a massive deal for Uber. Charles, do you get your alcohol delivered by Uber?
I actually get mine delivered by a guy in a trench coat. That no. I actually have done mail order alcohol before. I don't remember who I don't think it was Uber that delivered it, but it was somebody. But the bigger picture here is certain habits have changed during the pandemic, and they don't necessarily go back. That my wife has gotten used to getting the groceries on Amazon, or I guess it's actually the Whole Foods. Whole Foods and Amazon are the same at this point. So the groceries just magically show up at the doorstep now. She doesn't have to deal with it. I don't have to deal with it. None of us have to deal with it. It just magically shows up. And once the pandemic is over and done with, that doesn't go away. Now, Uber does ultimately have other problems. And the biggest problem, in my view, is just competition. There's not like they have a monopoly on delivering booze to someone's house or delivering packages or whatever. There's definitely room for competition here. It's an internet-based app. How hard is it to start something like that to compete? So I think competition is going to be, it's going to be, that doesn't go away. But the overall theme of, the convenience of just having stuff show up at your doorstep. Do you really think we're going to go back to the way it was before of, having to slog it to the store in 5-degree temperature? No, well, 5 degrees. You see, it's not exactly 5 degrees where I am right now, but
that's beautiful.
This is the happiest I've ever been not to be in Dallas, but at any rate, I think that is a good long-term move for Uber. It does make sense to diversify away from just the core, effective taxi cab replacement strategy they had. So they have some things going for them. The question, of course, remains: is the stock reasonably priced? I'm a little skeptical on that, but I do think the company has made some really good moves over the past year.
Yeah, Rodney, I agree with Charles. Diversifying here, you have that army of drivers out there doing more than just doing ride sharing. What do you what's your outlook here for Uber?
Well, I don't think Uber makes money yet. And I haven't looked in the last few months, but I think they're still losing money. I have a real problem with that because I think they've passed their peak, and their peak was all of us in downtown, whatever, riding Uber. Now they have moved to the suburbs. Their ridership is actually about 50-50 suburbs to urban areas. But to Charles's point, it's competition. I mean, you're giving somebody a ride. And so this is not a hard thing to do. And there are a lot of other companies that do delivery of goods. Shipt comes to mind, right? And so there are a ton of people that can do this. And so my problem is, as the business of delivery, becomes embedded, doesn't that just attract the competition? And so it's this continuing downward arc of profitability for the company. And so how do they ever justify a rising stock price? I don't see it, because they become a commodity. There's nothing cool they can add to it, right? They're not like Tesla, which, I've been a, Tesla detractor for a long time, but they can make a cool car. They can make another car that we love. Is Uber going to make a ride you love? It just seems so odd that this would give them some growth. I don't see it coming.
They could limit their cars to only Teslas. I mean, Uber does have some, cool factor things that they're working on. I mean, they still have this dream of having the, fully autonomous, Uber cars with no driver that just go around picking people up. I don't know how realistic that is. That may be something that happens 10 years from now, if it ever happens. Yeah. But I agree. The issue with Uber is, does it justify the multiple it has? You can't even call it an earnings multiple because they don't have earnings yet. Does it justify the sales multiple they have? The answer is no, probably not. As one aside, so the delivery thing is not just a US phenomenon. I'm in Peru at the moment, and I don't think anybody ever leaves their house here anymore. There's just always some dude on a motorcycle available. You want a $10, I don't know, prescription picked up from the pharmacy. There is a service for that. There is a guy on a motorcycle that will go pick up your $10, bag of pills and just show up to your door. You need whatever. I mean, you want a 6-pack of beer, they'll deliver that. I mean, they will deliver anything. And there are various services that there's various companies that all provide the same service. And it's always, who wants to fight traffic in a developing country? Nobody. But you're willing to pay a small premium to have some dude on a motorcycle just make it happen for you.
Yeah. And what I'll say, for me personally, I like the ease. I like the ability, and I think some people would agree, I like to have one app. I don't want to say I get food delivery and I get alcohol delivery and I do ride sharing and who knows what else Uber will get into. Maybe it'll give me a bag of pills. I like to just go into one app and select what I want. I don't want to have to deal with 4 or 5 different apps. And if Uber has an army of drivers out there, more so than the competition, and I can just click through and get whatever I want through using the same company.
I do want to emphasize, when I said bag of pills, that sounded kind of illicit. I mean, like a prescription from the doctor. I was not referring to something dodgy in a dark alley.
Well, you did mention having things delivered by a guy in a trench coat, but that's very different.
I really am kind of incriminating myself here, aren't I?
One potential pitfall for Uber is something, Charles, you mentioned earlier, which is the $15 minimum wage. Would this be something people have an eye out on, and how this might affect Uber?
I'll let Rodney do the heavy lifting on this one. That was more his point. But it is the issue with Uber is, okay, if all of a sudden you're having to count these people as employees, what do they do? Do they restrict hours? Because that's one of the things that I believe one of the strategies they had in California was, okay, if these people are no longer contractors, they're employees, we're just going to have to, we don't want to do this, but we're just going to have to reduce the number of hours that they can be a driver and force them down to a level that made it plausible that they're a contractor, not a full-time employee. So labor unrest, I think, is going to be, it's funny, labor unrest really hasn't been a major issue in the United States since the 1970s. Labor, the power of unions and whatnot has been in terminal decline. It does seem like lately it has had some sort of resurgence. I'm not sure really how strong this resurgence is. I don't know how much support they're going to get in Congress and the courts. I do feel like, particularly on the Democrat side, there is more sympathy with organized labor, but I think more of it's rhetorical. I think when it comes down to actually making it happen, I don't see it happening. I think they learned their mistakes from the past. They realize militant organized labor is really a problem, and so they're not going to bring that back.
Rodney, what can a $15 minimum wage legislation do to Uber? Would it even apply to Uber?
Well, it wouldn't apply today, but there is this falling domino effect, right? So some California Uber drivers said, hey, we're employees, we're going to unionize, we're going to do these things. That thing is still being fought in the courts. The National Labor Relations Board is appointed by the members or appointed by the president. And so President Trump did not sit very favorably towards unions doing this sort of thing. He was a union guy, if you recall, when he got elected in 2016. But Biden has been very clear. He's a union guy. He is all about this. And so if you have people who are saying, hey, look, I drive for Uber. It's what I do full time. I work for them, blah, blah, blah. I may not agree with how they present it, because to be an employee, your employer is supposed to control when you work and where you work and those things. And with Uber, you can choose to join or not join any day at any hour, right, to drive. But still, if they get this put through, then yeah, this is going to be a thing. And then minimum wage will apply, and so will benefits and all sorts of other things. And so there's a lot that could kind of roll downhill here that would be bad for Uber, but it's not Uber. It's every single company doing this, right? And so you all of a sudden make all delivery more expensive. You make all transportation more expensive. And then you curb it because fewer people want to pay as much. One of the reasons we took Uber is it was about half the cost of a taxi. I mean, it didn't smell bad either. But so there was a reason why, you said, oh, I'll take an Uber. It's $10 versus a $20 cab ride. Yeah. And so if you make it closer to parity with cabs, then you've taken out a lot of the demand that would have been there.
Yeah, that is absolutely true. The other side to that, of course, is what does this look like going forward? I mean, Amazon may be the single most innovative large company in the world. I mean, I really love Amazon. If you had a Mount Rushmore of great capitalists, Jeff Bezos's head needs to be on that mountain. Henry Ford, Jeff Bezos, Rockefeller. I don't know, like he needs to be in that top four. But what is Amazon doing? Amazon is looking to bypass human drivers altogether and have drone deliveries. And look at the Amazon warehouses. Like, there's some complaints that they work their workers too hard, and I don't know, maybe they do, but they also run the most labor unintensive factories we've probably ever, factories is the wrong word, distribution centers we've ever seen. I mean, these things they're not fully automated, but they're highly automated. So you do introduce you do introduce a higher minimum wage, and the delivery services, I don't know, do they switch to drones? That's not something that happens overnight. There's laws that have to be written to make that possible, but I think it does speed up the eventual process that the delivery, the dude on a motorcycle that I've been talking about gets replaced by an unmanned drone.
Interesting. That sounds a little dystopian to me, Rodney. Drone delivery.
Eventually, it's coming. But the FAA rules and other things are going to be a thing. The weight to, flight ratio and time and distance are going to be a thing.
Yeah. And the guy standing out in his backyard with a shotgun blowing one out of the sky.
That would be me. I am all about it, because the noise, the aggravation, the clutter in the sky, I'm not a fan. Right. So yeah. I would be the guy wanting to stand in my backyard with a shotgun and pop these things, but we'll see.
We're going to leave it right here, but I think this actually is quite a bigger topic that I think we're going to end up circling back to, this idea of innovation, growth versus how you pay your workers, and the fight between those two things. So it is an interesting debate going on, and we will see what happens. Certainly the future to me looks bright for Uber, but yeah, certain things like having to maybe double the pay of your drivers or something like that, or give them certain protections could be a threat to that. So very interesting to see going forward. I want to thank you all for watching. Please sign up for our free newsletter at wallstreetwirenews.com. Rodney, when they do that, what kind of stories can people get in their inbox in the financial side in the coming days?
Well, I mean, they have a holiday on Monday. The markets are closed, so you're not going to see anything on that. And then it's going to be the relief bill is going to be a conversation if it moves forward. But all that is really going to be behind the impeachment. And so if the impeachment wraps up by, the weekend or Monday, then it's going to be right back to this relief bill. And what does 1.9 trillion mean to the economy? And we don't know yet. It's going to be interesting.
Charles, how can people find your work? And do you have any thoughts on the week ahead in the financial markets?
It's just 1.9 trillion. Just what's 1.9 trillion among
It's no
friends,
big deal.
right? Just no big deal. It's just, those are the numbers we throw around now. But at any rate, to find me at charlessizemore.com is the easiest place. As for the week ahead, I agree. It's going to be mostly kind of impeachment headlines. And once that's wrapped up, it's going to be all about stimulus.
Great. For Rodney Johnson and Charles Sizemore, I'm Dave Okenquist, and have a great trading day.